We've learned that financial instruments are nothing more than formalized IOUs, also known as promissory notes. Now, IOUs come in all sizes. But is there a limit to the size of IOUs? Can one person or one company write a billion-dollar IOU? The answer is yes. In fact, in 2012, the American company United Technologies wrote a $10 billion IOU, which was the single largest amount borrowed by a company in 3 years. Other companies have borrowed even more in a single transaction. Ford, for example, borrowed over $14 billion before the financial crisis in order to fund an overhaul of its global car business. Who on earth could possibly lend that much money? Given what we've learned in the previous lecture, you might say that a bank could do that. But although many banks are large, they generally don't want to put all their eggs in one basket by lending $1 billion or more to a single borrower. What banks will do, however, is join together and make a joint loan called a syndicated loan to a single borrower. Syndicated loans of up to a few $billion do take place in the financial markets, but there's a limited capacity for banks to make really large loans like that. Generally, if you want to write an IOU for a lot of money, millions or even billions of dollars, you have to use a different way to borrow. The main way to do it, in fact, is to borrow by using bonds. Even though most of us will never issue a $1 billion IOU, bonds still have a big influence on our financial lives. The interest rates paid on bonds directly influence the rates that we earn on our bank deposits and the rates we pay on our mortgages and other loans. It's fair to say that the interest rates on bonds lead and the interest rates on consumer deposits and loans follow along. Bonds are also a popular and important investment for most households. In fact, most financial advisors recommend that by the time you retire, most of your retirement funds should be invested in bonds. Bonds, like all other financial instruments, are contracts. Let's take a quick look at the bond contract and get a feel for how the bond contract differs from the borrowing contract we've already learned about, the bank loan. The technical name for the bond contract is a bond indenture. The modern bond indenture looks a great deal like a standard bank loan contract. The indenture describes the terms of the loan and includes restrictive covenants. When you get into the details, though, it becomes clear that bonds differ from bank loans in several important ways. First, bonds tend to have a different arrangement for repayment than most bank loans. In a previous lecture, we learned how most bank loans call for monthly payments, and each payment includes both interest and a partial repayment of the total amount borrowed. The standard bond, on the other hand, calls for semi-annual payments. That is, the borrower makes a payment only 2 times per year, once every 6 months. No principal is paid back until the end of the bond contract, which we call the maturity of the bond. Every 6 months, the borrower simply pays the accumulated interest on the amount they borrowed. Because the borrower doesn't pay off the principal until the end of the bond, the interest payment stays the same throughout the life of the bond. At maturity, the borrower pays the final interest payment and repays the original amount borrowed as well. The interest payments on a bond are called coupons. That's because in the old days, lenders would literally receive a sheet of coupons that they would have to cut out and send in to the borrower, who would then send money back in exchange for that coupon. The amount of the coupon is determined by an interest rate called, not surprisingly, the coupon rate, or coupon yield. The coupon rate is set at the start of the bond contract, and it's usually chosen to match the market interest rate at the time the bond is issued. Let me make this more concrete with an example. Suppose a company borrows $1 million by using a bond that has a coupon rate of 4% and a maturity of 5 years. So we know that every 6 months, the borrower will pay a coupon to the lender, and then at the end of the 5 years, the borrower will pay the final coupon to the lender as well as repay the entire $1 million. What's the amount of the coupon that's paid every 6 months? Well, it's all the interest on $1 million that's earned in 6 months when the annual interest rate is 4%. Now, it's tempting to say that since 6 months is half a year, then the amount of interest earned should be half of 4%, or 2%. Well, in this case, you'd be right. because bond interest rates are all quoted so that the interest rate paid over 6 months is indeed half the quoted annual interest rate. This is a special convention that is used in the bond market, though, so keep in mind that it's only true in the bond market that the half-year interest rate is 1/2 of the annual